I'm Rick Bensignor, and welcome to In the Know Trader. This week on the show, we're going to take a look at the macro sectors relative to the S&P, as we do each week. We'll take a look at the S&P itself. And this week, I thought what would be a good idea to take a look at are some other country ETFs, other places outside of the U.S. to potentially invest in or not invest in, depending upon what their charts say. But we'll take a look at a dozen different country ETFs, although one of them is actually FEZ. The ticker FEZ is the Euro Stocks 50. So that's kind of the top 50 names in Europe. So we'll look at Canada, Mexico, and Brazil here in the this part of the world. Then we'll look at Europe. Again, the FEZ is the Euro Stocks 50. We'll look at Germany, France, Italy, and Spain. And then we'll take a look more towards Asia and India, China, Japan, and Russia. So you'll get a good sense of which ones are good, which ones may not be, in order to invest, because it's really important to get some exposure outside of the United States. And even though the U.S. has been the best performing index, when we talk in ETF terms, in the S&P 500, it's kind of been the home run over the last few years. There are definitely different times that other countries take the lead and perform better. So you definitely want to have some exposure outside of the U.S. Years ago, that was a very difficult thing to be able to do. But with the advent of ETFs in the last 20 years or so, and the ease at which you can easily now get exposure to other parts of the world, I highly suggest that you have part of your portfolio outside of the US. So we'll take a look at that. As far as some upcoming public appearances, I've got a special link here. I'll be talking on Saturday, February 8th at the Orlando Money Show in Orlando, Florida, to sign up for that free conference. That lasts, it's 3 days. And it is the best thing they do about this conference is it's free, and you have access to dozens and dozens of different speakers. So any of the money shows, and they tend to do them all over the country. So if you get a chance to get to this one or any of the ones, check it out at moneyshow.com. Just an easy link to sign up is inthenowtrader.orlandomoneyshow.com, and that'll get you signed up also for my talk. Also, I made a mistake last week. I was thinking that I was on Bloomberg TV today, Tuesday, the 11th. I am not. I am on next Tuesday, which is, well, actually Tuesday the 10th, but actually it's Tuesday the 17th. So December 17th at 8 a.m., I will be guest hosting on Bloomberg TV from 8 till 8:40 a.m. So if you have a chance, tune in, and I'm sure you'll be able to hear a lot of different things in that 40-minute time frame that we'll be talking about as far as my opinions on a variety of different markets. Okie doke, let's move and start in the sense of let's compare the S&P this week versus last week as far as year-to-date performance. We do this every week to see what's changed in the prior week. And for the first time in a long time that I can recall, there's only one sector out of the 11 macro sectors that actually moved relative to the S&P 1% or more in the past week. And the only one that's had any real movement is the real estate sector, which last week was up about 70 or so basis points as versus the S&P year to date. And as of yesterday's close, it's up 1.87%. So it is outperforming. It did never tuck into underperforming territory on a week-over-week basis, but recall this was up about 10% versus the S&P just earlier in the fall. So they have crushed REITs, and then you're starting to see that there is some little bid back to them recently as this picked up over 100 basis points in the last week. Otherwise, everything else is mostly the same. For sure, the best performing sector this year has been technology. It's up over 1,700 basis points relative to the S&P's performance, and the S&P's performance is somewhere around 24, 25% itself. So this is outperforming that by another 17%. This year's dog sector has been energy. It is down 18% relative to the S&P, so it is up on the year, but no other sector would have performed as poorly as energy. And that's not just a 2019 story, that's virtually a 20-year story. Energy has been the worst performing sector over the last 20 years. Nowhere else would you have made so little money, if anything, being invested in as the energy sector. So anywhere else, any of the other 10 sectors, you would have done better. Okay, how to contact me. It's rick@intheknowtrader.com, and we get lots of emails from listeners each week, so I appreciate that, and I respond, I'd say virtually 99% of the time within 24 hours. And our website is www.intheknowtrader.com. There's plenty of information about what we do, the background I have, as well as how to sign up to be a subscriber to In the Know Trader, which is a weekly newsletter, comes out Wednesday nights, reviews everything going on in the S&P, as well as gives a new ETF trading idea each week and follows up on all the open positions that we have from prior weeks. So from the time we get you into a trade until the time we get you out of a trade, every single week there's follow-up on that trade. So you never have to look back, a month and say, gee, do we still have this, etc. It's always updated week by week. And occasionally I need to move stops and or targets, and we do that each week there too. So that's what you get from In the Know Trader. All right, let's move to our charts and start off by looking at the S&P. Here's a chart you've seen for quite some time, because every week we're going to take a look at it. And of course, the two key things here highlighted just in general are the circled Tom DeMark sequential 13 upside exhaustion signals. This is an institutionally derived model that Tom created back in the 1970s, and it's one of the real edges that we have compared to looking at regular charts, because this model is virtually institutionally used only. Now I have access to it, I pay for it, and what I'd like to do in the Know Trader is bring to you, the individual private investor, access to one of the foremost models used by institutions to help time trend exhaustion, as well as being able to get into a trend that's moving. And what these signals that are circled represent is a particular pattern in the market. I'm not going to go through. There's several videos that I've done on this for StockCharts. So if you go back to I think it was January 29th of 2019, and the following three shows that we did after that, we spent the bulk of those 4 shows talking about how to use this model and how things are represented by the model. But in a very quick nutshell, when you have a 13 signal showing up above the price bars, as you saw in the middle of November and you saw in the middle of July, those tend to indicate a very bad time to be a buyer in an uptrend, and often a good time to be a seller, a place that we often take profits. You can see back in here on the left side of the chart. So if we look at this July signal, we went sideways for a couple of weeks, and then we fell a couple hundred S&P points into the August lows. The signal showed up again. Actually, the signal showed up in October. Because of a certain rule, it disappeared, but it has now been in effect. Another one showed up in mid-November. Looks like it was November 19th was the day of the signal, and we've basically gone nowhere since. So it's been a good signal in a sense. You have to understand what the signal represents. It at a minimum, it would say it's a bad time to be a buyer in an uptrend. In other words, that the risk is very high to first be putting on long exposure there. Secondly, think of it in terms of there are three trends in the market. There's up, there's down, there's sideways. So if you have a change of trend from a trend that's been moving higher, it doesn't mean you have to go lower. It just means you're no longer likely going higher. And for the last month, that's been the case, because if you look at from October to November until we got the signal, the market really from mid-October was straight up. It's now gone nowhere for almost a month. So this has been an effective signal in suggesting that there was a change in trend. Now, the bigger trend is still up and we're still bullish, but shorter term, this help identify, you know what, you don't have to jump in necessarily and buy now. The risk is high. Now, add to that all the political things going on, and it kind of makes sense that you may not want to be putting new capital to work at this point. At the same time, it doesn't mean that you can't ride what you've had from all your purchases in the past. The market is virtually on all-time highs. We're still less than 1% from all-time highs. But that's what this signal does, is often alert you to bad time to buy in an uptrend or bad time to sell in a downtrend. If that 13 showed up underneath price action as something was trending lower, it would give you the clue that this is not a good time to be a seller. So in the case of here now, it's saying you could do some selling. You certainly can stay long what you're long, but questionable whether or not you want to be a buyer until the signal gets stopped out. Now, how would it get stopped out? Yesterday was a down close, so if today closes up on the day, and as I record, the S&P is up about 3 points. If it closes today above 3141.81, so roughly we'll call it 3142, opens higher tomorrow and takes out today's high, then it would say that this 13 is no longer accurate and the trend has resumed itself and we can go higher. Now, on top of that, that's just purely technical. Understand that the Fed started a 2-day meeting today, so tomorrow at 2 p.m. we'll get an idea if they're doing anything with rates. The market certainly doesn't have anything priced in for any chance at all that the Fed's going to do anything tomorrow, but you never do know, so that's something that's certainly important. And the other thing that we've been keying off of, and a reason why last week we reduced some of our overall general long exposure, is that you've got the tariff issue that is going to be decided by I think it's Sunday. So it's December 15th, and whether or not President Trump is going to impose further tariffs on China. And if so, I do not think the market will take well to it. So you have a skewed risk reward here, especially given the 13 signal of whether or not you want to be buying or selling. So we've actually taken some risk down to just, I don't mind putting on at higher prices if these models suggest we do, and if the tariffs aren't imposed. But if the tariffs are imposed, we could see this deflate the market quickly. Now, is it necessarily going to change my whole view about long-term bullishness? No, it will not. And you would have to get substantially lower for that to change. But for the time being, I just think the risk is high in the market, and therefore that's why we took some exposure down. We told in the no trader clients last week also that we are lightening some of the exposure in general, even though that didn't mean that we took off specific trade recommendations we had on. I was just saying in general, you may want to lower some of your exposure. So that's my look on, that's my take on the S&P right here and now. Let's take a look at some of these country charts, and we're going to start off, as I said, with Canada. I'm going to default here to looking at weekly charts going back several years, just to give a broad picture of what's going on, and then we can hone in more specifically if we need to on shorter term charts. So what's of note here? Well, first off, the all-time high. Let's back here in 2014, I'm pretty sure that's actually not the all-time high. The all-time high comes all the way back in 2007, and notice what accompanied it: a 13 exhaustion signal on the upside. Notice in 2009, the model said downside exhaustion on the lowest low of the entire move. Look at 2011, upside exhaustion 2014, downside exhaustion 2015, less than a month from the low. And what are we showing now? So let's zoom in. Upside exhaustion just over a month ago on a weekly chart. We've gone sideways since there. And we're still below the 2016 high, so it still makes me somewhat concerned about adding here. I rather buy on a pullback than chasing after here. Now, currently, this is trading at 29.47 as I speak. There is a target on the upside of 30.40. 30.40, that is a propulsion exhaustion level from a different DeMark model. So if we can get above there, then that opens the door for this to get to 33.50. So anywhere here from 29 at roughly 29.5 to roughly 30.5, that somewhat 3% range is still potential resistance here. I'd rather be a buyer. So if this pulled back, I'd rather be a buyer at just under 28 or so if that opportunity came again, rather than paying right here, right now. So that's my take on Canada. EWW is Mexico. And looking back, I see some 13 somewhat near bottoms. The ultimate bottom came in here in 2017 before a big rally, but you can see this is generally trending lower over time. I do actually have some Mexico exposure on for my institutional clients. I think we still have this on. We got long somewhere back in here, so we're just kind of break even here. So this is not done well. I mean, we haven't lost money, but it certainly hasn't captured what the S&P has or some other markets over the last month or two. So we'll be watching this. Also notice, just as part of that DeMark sequential model, that a lot of times you'll see blue nines also called turns, and that's part of the model. The 13s are often more definitive, but a lot of times you'll see 9 counts call turns, and what those 9 counts are consecutive weeks here. Let's take a look at an example of, I'll blow this up a bit just so you can hone in. When you've got a blue number coming on top of a price bar, its close, and these are weekly charts, so the Friday close is above the close from 4 bars prior, and it needs to do this 9 consecutive weeks in a row. If any time along the way you don't close above the close from 4 weeks back, the numbers drop off. So often when you get to a 9, you get a short-term change in direction. You did so on the peak here. You did so 1 week after the bottom back here in November of last year. So these 9 counts, this 9 count back here all the way on the left side, I'm looking back into 2017, looks like it came a week or two before the high, and it kind of went sideways, and then it fell. And it fell into a 9 down, and again, that was kind of a temporary low for a few months. Ultimately made a 13. This 13 you wouldn't have traded at the time because of it also started a new count. So not until this 9 here would you have considered being a buyer. And if you did at the time, it was a good buy. All right, so that's Mexico. Let's look at Brazil. So Brazil, look at this here. Upside exhaustion earlier this year over the summer. Upside exhaustion. In fact, you had the 13s and 9s come together. 2 months straight down from there. Now it's trying to make its way back up. Hasn't taken it out until there's a couple bars of resistance here. This is the little dotted blue line, 46.5. 46.78 is the propulsion upside target. And that weekly 13 does not get stopped out until proper closes above 49.14. So right here, right now, same type thing. No particular edge in being long this. MACD crosses very close to each other, nothing special there. The cloud chart has crosses constantly, so that kind of implies a sideways market. So not a huge edge in being long this, other than from, let's say, if you've had it from the past. But I'm guessing when we look through these dozen countries, we're going to find better ones than Brazil to buy right now. Moving on, Fez. This is the Euro Stocks 50. Right, so this is kind of the Dow Jones Industrials of Europe. Think of it that way. The top 50 names across Europe. Take a look at last December, downside exhaustion. Take a look at what we've seen, I guess about 2 months ago, upside exhaustion. It has gone a little past there. It has not gone through the stop out level of 40.51, which would indicate the 13 is wrong. So this is kind of just biding time here. If it got down to 37, I'd probably be a buyer, because longer term, I do like the markets. But for right here, right now, nothing special. And we're also stalling against these little blue triangles, which are propulsion exhaustion levels. So rather buy on a pullback than in here. Germany, EWG. This now has two clear bottoms not that long ago. Right, so the Christmas low last year, but Germany also put in a bottom this summer. Now it is stalling against this TDST line resistance. That's the highest high in the 9 count. That was down here. So you'll see that that line came from bar 1's true high, which in this case, because he capped down, was the close the day before, or in this case, the close the week before. So it needs to get, if this can get Friday closes above 29.19, you increase the odds that you can next get to 31.08. Full breakout on the upside, measures all the way up to 37.76. So this is also Germany, at least I know, besides the Christmas bottom from last year, which many of the charts have, this also got one in August. And you can see if you had bought it around there, not only did this reject the propulsion, you would have got new signals underneath here if it properly closed underneath. It did not. This is a bullish chart. So Germany far better than Brazil and, let's say, Canada, in the sense that you're buying something that at least has been beaten down and it still hasn't rallied so much that you don't feel like you're chasing too badly. EWQ is France. France got, like so many other markets, which is why we were bullish and did not turn bearish the way almost every other technician did last December, saying that a new bear market had started. We said that the Christmas low last year was the culmination of the global equity indices bear markets, and that you needed to be a buyer. And we said that on January 10th of this year. So we virtually have been long the entire year. You've got some, again, here in France, a signal that showed up about 6-7 weeks ago. It has pushed through there, but hasn't gotten through the propulsion target. So we've really kind of stalled out against there. And this is just biding its time. Get above 32.32 on multiple Fridays, and then this should be off to the races. On the upside, if you get the chance to pay 30-ish, I'd be happy to do that on the downside. Italy. There's a place probably not too many think about as a major market, but it's still one of the bigger European markets. So last Christmas, you were closer to a 9 count. This had a 13 a while ago, and in August also, but you can see we've advanced since there and stopped against the stop out point of the 13. So the high this year is the stop out level. So if we make new highs now, look for it to then push up to 30.60 on a full breakout above there. Then longer term, you're talking about a move all the way up to 38.02. That's comparable to the S&P getting up to, I think, 33. I'm trying to remember what number we had on the weekly. Well, actually, if we have time at the end, we'll take a look. Spain, EWP. So this is kind of got a double bottom from last Christmas low is right in here. This year's low, same level, 26 bottom. Moved up, stopped on a 9 count, pulled back, and it's kind of finding its way. If you can get qualified and confirmed closes above 29.40, this should then get you to almost 33. That would be the breakout to buy. So ideally what you're looking for is the week before you close above 29.40. Hopefully that is a down close. Sellers showed up relative to the week before that. Then close above 29.40 on a Friday, gap open the next Monday, take out the prior week's high. You get a full-scale buy signal looking there for 32.85. So this is going to be on my radar screen as a potential buy going forward. Let's move to Asia, and we'll first start off with India. Now, this has been a much choppier market. In fact, I'm going to take the cloud off because it's kind of just noisy here. And I'm going to look more at some of the signals. So a 13 upside exhaustion signal here got you kind of 2 months or almost 2 months of sideways. There was one move down to a propulsion level that if you properly broke it would have been bearish. It didn't. That actually makes it bullish. You've got a 9 count here that got a bounce. You've got a 9 count here that was close to the bottom. And this 13, so you've got plenty here to go and play for bottoms. We did in the No Trader. We've played some of these 9 counts too. I think we even played this this summer, although I don't remember, but I think we played this earlier. So notice this is actually trades almost back and forth on 9 counts. And in the big picture here, so here, let's just take a trend line. So if you can break through the TDST line at 35.85, you will have also broken above the trend line. So that's your key level. Friday close above 35.85 gets you the breakout to, it should get you to 38.5. China, I'm going to use, there's a ton of ETFs for China, but I'm going to use the biggest one, which is FXI. It's a top 20 ETF trade of all the ETFs traded. And back in 2016, you'll see we have exhaustion for the low. This was not a good signal. It only worked for a month. And you can see how choppy it is. Most importantly is the down move we saw in the middle of the year. Stopped right on the propulsion exhaustion signal. It's come back. It's still in choppy waters, and obviously China's forefront to the headlines these days. So right now I would use boundaries as 39-ish on the downside, 44-ish on the upside. Get above 44, you can get to 50. So that would be a good upside breakout. Japan, EWJ, also one of the biggest ETFs traded. Bottom, interesting. So last Christmas didn't have a 13. That 13 didn't come for a buy signal or essentially a downside exhaustion signal until February. And since that signal, you'll see it never got lower. So when months kind of back and forth, and then finally, since summertime, broke out to the upside, multiple targets up here just north of 61. You're going to see some resistance here. If you bust through it, then this thing really has room on the upside. So I'd pay attention to how it acts just north of 61. And if something happened over the next few weeks that for some reason we got down to 57-ish, I'd be a buyer there. Lastly, Russia, RSX. Here we go. So 13 buy signal. So remember, most of the world, well, here, I'll take that back. Just buy signal or downside exhaustion here in the early part of 2016. That's where most of the world bottomed at the same time. Notice there's an upside exhaustion here, which worked for half a year. There's a whole cluster in here. Well, I didn't draw the circle right, but kind of sideways, a 13 for upside exhaustion here, which worked for half a year and lower prices, and nothing much since. Let me just look where all-time highs are, and we will finish. Okay, so this, if we can get above this, the high from this year, then I think Russia has room to go on the upside. Otherwise, it's dead money. That's it for this week. I'm Rick Bensignor. I hope you enjoyed the show, and this has been In the No Trader.